Matt Graham is the founder, CEO of MBS Live, known to all of you all as the voice of reason, the man behind the scenes in the markets, giving us an update of what's going on. Matt Graham, how's things up in Portland? Do you have a good weekend?
Yeah. Every weekend is working on the farm now. So
I was going to say, you're a farmer.
Yeah.
Do you have the bib overalls and the whole thing? Do you do the whole bib
Yeah, with
thing?
no shirt and a piece of straw. Yeah.
Oh, yeah.
And I just say yup a lot, and then I spit. And
that's because you're working with your wife. You're a smart man. Yep, honey. Yes, honey. Yes.
There you go.
Yep.
So I always like to piggyback on things Les said, and I agree and disagree with a couple of things. And it's a friendly disagreement. Disagreement leads to conversation, right? I agree that there is a range going on. I don't know if I would classify it as erratic. I think it's pretty narrow and pretty regular, and I think that it does speak to indecision about economic conditions. There's a lot of jockeying amongst analysts to call a recession versus calling, hey, it's not going to be as bad as you think, or hey, things are a lot better than you think. And even just this morning, we had a Fed speaker say that actually it's the top headline on MBS Live. The economy is not slowing as much as people think, says former Fed President Robert Kaplan. So there's a lot of that sentiment around, and then there's a lot of the sentiment about the impending recession, even if you look at things like leading economic indicators, which Wells Fargo's analysts have been keen to point out is very much in line with recessions in the past. So this range and the sideways grind is really emblematic of that indecision. And it's also emblematic of the fact that month-over-month inflation readings haven't really picked a side yet when we're looking at, especially at core services inflation. It's really just a consolidation pattern, and it's not one that is pointing in a lower direction in terms of month-over-month readings. A lot of people confuse the fact that year-over-year inflation has fallen quite nicely from the highs and say, oh, look, inflation's on the way back down. Shouldn't rates be on the way back down too? But that's not really how it works, because year-over-year inflation is going to flatten out unless month-over-month inflation goes lower. And right now we're just seeing the dropping off of the ultra-high inflation months of the past from the 12-month equation, and that's what's making the annual total go down. Only other thing with Les, here's the big disagreement, and Les, maybe he might even call in and give me a piece of his mind. But I don't think there's anything interesting happening in oil. When I zoom out to the big picture, I see the huge spike up to 120 plus or 120-ish, and a initially rapid but then gradual descent back toward this $70 a barrel range, and really hasn't moved much in the past few days, weeks, at least all the way back to the beginning of May. It's been a very tight range. It always makes headlines, and it always is interesting. And there were a few times last week, to Les's credit, where I almost wrote about oil's interaction with the bond market and the implications there. And I think there maybe were some oil-based implications to over the weekend volatility surrounding the potential military coup in Russia that kind of flared up and fizzled out. But in general, oil is an input for inflation, and so it's relevant to bonds, and sometimes more so than others, depending on what else bonds are paying attention to. Speaking of that, what else are bonds paying attention to? When things are as flat as they were last week, you just pick what you want to talk about from an analyst standpoint, and the odds-on favorite would be Powell's congressional testimony last week. I think my biggest takeaway from that was the fact that he had an opportunity finally to answer a very thoughtful question. I don't remember which senator asked, or maybe it was a congressperson, something about, Powell said, if the economy evolves as we expect, then we see 2 more rate hikes. And the very logical, very simple question was, okay, can you define what as you expect means? And Powell may or may not have simply been recapping their summary of economic projections, but he said, if inflation continues to moderate, if the labor market continues to soften, and if the economy continues to grow at a modest pace, then that would be evolving as expected, and that would be in line with 2 more rate hikes. So it's basically, there were some people out there, and at times myself, who were assuming that inflation would need to remain high, or that the economy would need to keep pushing for this apparent resilience that it has done in several economic reports in order for the Fed to be interested in continuing rate hikes. But Powell's basically saying, no, we don't need the economy to surge. We don't need any of that. We just need things to keep moderating. If things could even soften in the labor market, and we would still want to hike twice. So it's maybe a little bit of a wake-up call along the same lines as that headline from Kaplan that I just read, talking about the fact that the economy might be really bad for people that are in an interest rate sensitive sector, but if you're looking at other numbers, it's not. And if you're looking at inflation specifically, we're not there yet. And that's the Fed's reminder. Some people think, yeah, we're not there yet, but we're definitely on the way. And then the argument there is like, how do we know we're on the way? And if we are, that's great. And we'll see the rates Les is talking about. I agree that we would. If we're not, then we're not. And that's why we're sideways grinding, waiting for the next shoe to drop. And in the near term, that shoe is defined by a range of 3.7 to 3.84 in terms of 10-year Treasury yields. And we see bonds continue to attack this 3.72 level. They did so again this morning. They're at 3.719 right now. So just to give you an idea of we're right in the thick of things. And once that breaks, then we're still quite a ways from the old 3.4 to 3.6 range. And I don't know, there's like little rungs on a ladder. We're bouncing between these ranges, but bigger picture change will require a sustainable shift in inflation. As far as what's coming up in the market this week, nothing earth-shattering. We have GDP, the first look at Q1 GDP on Thursday, as well as jobless claims, which continues to be interesting. And Friday, we have PCE, the PCE inflation index or PCE price index. And not to be confused with CPI, it comes out 2 weeks later. It doesn't punch quite as hard as CPI because of that, but it can nonetheless offer insight into that big picture inflation outlook that we're talking about. Other than that, just a couple housing-related reports, new home sales and prices tomorrow, and then we have pending home sales later in the week to round out what was last week a pretty solid week of housing-related data, but one that just suggests that the free fall in sales and such is over, stabilizing, and we're waiting to see what a recovery might look like. That's all I got.
A recovery, word of recovery. Like those words sounding, but we don't know when. Great point. Good sign. Les has not commented or texted in, so
I threaded the needle, maybe.
You thread that one. You may have threaded that one, but good job. And I do the varying thoughts on that. I'm looking at the economics data slides that they published last week, and they did this at I'm sliding up the beginning of this, but last week the MBA put on the MBA Single Family Research and Economics Showcase of 2023. It's on the website. If you're a member, you can download that. I have access to these reports, and I don't know to what extent that is available to others, but I'm looking at all the data here, tons and tons of data. We may do a podcast just specially on that, Matt, and get your thoughts. I'll get this over to you, Matt, so you can take a look at it and then give me your thoughts on it. Have you already seen the slide?
I might, but I haven't seen it. I may have it in my email somewhere, but I haven't seen it yet.
I'll make sure you get it, and because there are some interesting things on there. But the one thing they're talking about is softening of the employment. So consistent with what you were thinking might happen. So anyway, good stuff. Matt Graham, appreciate you being here. Sign up for Matt's service, mbslive.net, net. And it's a great place to fall into and get caught up in all the data, playing the word net there. Anyway, if you're signing up, use the word LOL for Lykken on Lending. In the sign-up code, you get an extended trial period without a credit card, but just get your credit card out, sign up for it. It's so affordable. How can anyone in this with this market and the volatility, whatever it is going to be, not have this information? You are going to be not as good at selling if you're being asked questions and you don't have this kind of a tool in your toolbox when talking to different borrowers, prospective borrowers. It's a great amount of information, robust as ever. I love it, what you do. Matt Graham, thank you so much for being here. Let's run around real quickly. Mark, do you have any questions for Matt that you want to ask before we move on to Mr. Kittle?
Yeah, Matt, I just want to ask you one quick question. When you look at numbers that are coming out and whatnot, do you see that do you see the progress that will happen for us here in the near future and it takes some time? Do you see it as something that will somewhat mirror what happened after 2007, 8, and 9? Because we talked about earlier about the volumes picking up in 2002 and 2003 after that. Do you see some of that same scenario playing out in the situation we're in today?
In terms of home sales or
Yes,
or
sir.
mortgage volume, yeah, that's tough. I don't see a ton of similarity, largely due to housing playing such a central role in the major recession, the biggest one since the Great Depression, and some skittishness when it came to people coming back into the market. Some huge opportunities for the people with the foresight to realize the worst was over, and that really led to uneven recovery, as did the home buyer tax credits, caused these two huge spikes in home sales that sort of threw off our ability to go back and really parse the data to see how and when things recovered. Right now, I think there's just an absolute ton of demand on the buy side of the housing market and just no inventory. So I think if rates drop to a point that frees up some inventory from existing homes, which is definitely a major theme right now, a lack of existing home inventory due to low rates locking people into their homes, psychologically or otherwise, there's a ton of demand out there. And maybe the only thing we'd need to be careful of if rates fell too fast would be too much supply, causing downward pressure on prices. I think that lower interest rates would offset that, so it's not a huge concern, but definitely helping keeping prices elevated right now to have such tight inventory. I think there's probably more upside on home sales back then than there would be now, but there's just as much upside on refis right now, especially the longer we go without a big drop in rates.
That's great. Thank you for the comments. Appreciate it.
Yeah.
Sign up. Thank you, Matt. Appreciate it. Sign up for mbslive.net. Appreciate you being here. And yes, you are each week, faithfully bringing us great information.